Good evening, everyone. Good evening. Big warm welcome to all of you. Thank you very much for joining me. My name is Adam from Trade with Precision. Good evening. I'm just sorry. I'm always chuffed when I have my regulars, so I appreciate that very much. So hello everyone else. Tonight's topic, brought to you again. My name Adam from Trade with Precision. It's an IC Markets webinar. Tonight's topic is stock indices head to head. We're going to have a look at the US markets versus China versus Europe. Hi Adrian, hi Radislav. So yeah, fantastic. We've obviously got a nice cross cultural, nice mix of everyone from all over the place. So that's fantastic. I would love for this to be as interactive as possible. Okay, so what I'm going to be doing is we'll go have a look at all the major indices. If you want me to have a look at something else and I will. I'd like to really kind of do some detailed analysis on it with an actual sort of trading plan / or kind of just some sort of plan as well with regards to each of those markets. And so we'll do that. What else? For those of you, again, who don't know me, I am based in the city of London, and I'm a day trader for the most part. I used to do a lot more swing trading, which really means I used to take a lot of trades on the daily and weekly. For the most part now, my stock portfolio is probably on the daily and weekly, whereas most of my trading is done during the day on the 15-minute to 4-hour time frames. Okay, so and in fact, I think we've had some really big moves today. Interesting enough, we had some stuff going on, and I think we should also talk about those. So on the agenda, we're going to talk about recent movements of interest, and that was, I think when the slide deck was done, they didn't know that today would happen, but some really interesting stuff. Live analysis of the major stock indices out of the US, China, and Europe, and then of course a watch list to keep an eye on through multiple time frames and what to do about it. Okay, so this is a little thing, but I used to, I found relatively quickly that if I did my market analysis on the weekend, not for very long, 1 or 2 hours on the weekend, it really helped create a watch list for the coming week, because the weekly candles do a move. So you can put aside a market, even though you look at the weekly, even though you intend to trade the 15-minute time frame, you can put aside a watch list and take your cues from the weekly and daily charts, even and then those moves might unfold on a Thursday or a Tuesday, whatever. So let's go across the platform. I've got obviously I've got the usual, the traditional platform, the browser version open. I've also got the NT5 platform. So a couple of things I want to talk about very quickly today. We've had some really big moves. The Swiss franc has historically always strengthened. So if we go look at Euro Swissy, if we look at Euro Swissy here, we go to much longer time frame. If we go to a really big time frame, we try to get as much history as we can. You can see that going back even to 94, you can see that the general direction for Euro Swissy, for example, has been generally to the downside. Okay, so what happened here? Well, the Swiss National Bank got very upset. This stuff is relevant partially to how it's going to impact the dollar, which is how it's going to impact the indices. Is the sound okay, by the way? Is the sound all right? Yeah, so what happened here was this started, this was a big move, and this just generally would always flow to the downside. So when did I come in? I was sort of learning how to trade somewhere around here. So for about a year or two, it was kind of moving down, and then there was intervention that the Swiss franc was getting too strong. And so they intervened. Now, SNB were silly about it because they didn't tell anyone. So they caused a little bit of damage. They caused damage by doing that. And then they set this sort of line in the sand was at 1.2. And you can see here after this, the market didn't really do much. So first of all, in every single market, Leon, good to have you with me as well. In every single market that exists, please remember that there is an underlying actual market. Don't forget, don't get caught up in thinking that the currency markets are only moving because of the news or because of hedge funds or whatever. The currency markets, before they were made available for trading, obviously currency markets have been around for hundreds of years technically, and although they started to then track it and run it through exchange systems, there's no central exchange, but through exchange systems, That was the 70s. And then it became available to retail traders in about 96, 97. So the reason I bring that up is because we forget. We hear the news and the media, and we convince ourselves that it's the new stuff that's driving the currency markets. But it's not. That's an added layer of activity. And so you have, businesses paying suppliers, banks accruing currencies. You have trade. Is that particular, is that country an export country or an import country, and how is trade impacting the value of the currency? And so that impacts it as well. And then on top of that, you have a layer of institutions and banks, and you have retail traders. And the retail traders, we were only 5% in the market in 2010. Now we're hitting between 15 to 30%, depending which one it is. Exactly. And banks involved in hedge funds as well. Thank you. So at this point, what happened here was they had carry trades. So this is important to give you a bit of background and history behind the markets. But there was a time when the interest rates, before 2007, before the global financial crisis, what they used to do in the past was that if the markets are getting a little bit too caught up, they would up the interest rates, which would cool the markets down, hopefully before inflation got out of control. So that's pretty normal. Inflation and recessions are all normally part of every time there's a market correction. And usually there's a market correction because they have to up the interest rates because of inflation. So that's a common kind of thing, even though we think it's happening for the first time now. It actually happens. It happens. It's pretty common. So here's the thing. They had these carry trades because the interest rates around the different banks around the world were quite different. I think with Australia, I think it was like 6 or 7% central bank interest rates, but out of Japan, it was like 0.4%. So then the big hedge funds and the banks started doing a thing called carry trades. They would literally borrow money at 0.5% and lend it out at 6 or 7%, and then they would pocket the difference. And if the currency moved in your favor, if the currency pair moved in your favor, you made extra money. It was called a carry trade, and they would just hold those positions. And so, ladies and gentlemen, that is why you would get these long-term flows in the markets. Then after 2007, 2009 sort of global financial crisis, they put the brakes on too late. They started upping the interest rates too late when nobody could actually afford to do that. So now people are overexposed, and upping the interest rates is going to cause people to default, and it did it, and it's going to happen now as well, or it would have potentially if people, if the cost of living and everything else has got too expensive, people can default if the interest rates get too high. So all of that means that a lot of the central banks around the world, all of the interest rates have become very similar and very low. They're all sitting around say negative for some countries, but let's say -% up to 2 or 3% around most of the big, like the G7, for example. So with the end result being that the carry traders died out. And so you don't get these nice, long, steady flows of things. The only exception to this being sort of the CHF, the Swiss franc, which is kind of generally headed quite a bit sort of lower, and so it continues to strengthen. And it just has, and then of course what they did was, so they did 3 really bad things. They intervened here, which shocked the market. Then they put a floor in here, which kind of messed with the market. So all the traders went away, all the other stuff went away, and it was literally just your normal exchange rate stuff, nothing else happening there. And then they depegged it here, and I was trading that day, that morning. I still remembered it, and the banks weren't even answering their phones. Anyway, and then they did this, and after that, nobody really wants to get involved with CHF because it actually messed up all the markets, and it destroyed a couple of brokerage houses. Anyhow, and you can see now that it's picked up, it's come back, tested that, and it's carrying on down. And so this is the general thing. So if we look at the other Swissy pairs, so I'm giving a bit of history lesson because the Bank of Japan had a similar problem. If you go back and you look at euro yen, and you look at a similar type of, was it euro yen or was it dollar yen? It was euro yen is fine. They also had a similar kind of longer term move. A lot of those types of moves were relatively steady, and it stands out a little bit more sort of a dollar yen. And they also have attempted to intervene in their currencies a couple of times as well. There's a couple of periods here where they've pushed and intervened to do that. They spoke today about not having intervened since 1988, but they were definitely also, both the Swiss National Bank and the Bank of Japan were concerned about their currencies and pushing to intervene. So I only tell you that because they've started kind of doing it again. We've had an incredibly strong dollar. So if we've got a dollar index, look at the dollar index. The dollar has been particularly strong. What's going on here, man? Come on. Let's just go through and have a look at what we've got here. What's my stuff? There. It's been particularly strong. for various other reasons. I'm not sure what's going on here. Come on, guys, give me my data. Might just not be enough data on it. That's fine. We'll leave it for now. Point is, the dollar's been incredibly strong over the last year. Look at that, and it's just pushed a lot of the currency pairs, especially on the weekly. We've had a very strong dollar, which is, and combined with a bit of inflation and a war breaking out, has caused a little bit of safe haven behavior. In addition to that, the Japanese yen has been going out of control. So the stronger dollar and the weaker yen has boosted dollar yen ridiculously, like to areas that it hasn't been before. But you can see, if you look at, say, euro yen, you can see that's been pushing up. If you look at pound yen, you can see that's been pushing up. Aussie yen has been pushing up. Look at Swissy yen as well. So the point is that it's become, especially from a monthly perspective, it's become quite overextended. The dollar hasn't been this strong in a very long time. The pound sterling has not been this weak ever, I believe, in the history. I have to go look further back. We've broken to new lows today, and we've never kind of been that weak against the dollar. So a whole lot of things are happening which haven't happened before. It's not necessarily a bad thing, but it just means like things can change. And again, the markets are only 20-something years old for retail traders. You know, call it 27 years old or something. It's not a long period of time. And I've been sort of trading for the last 12, 13 years of that. So almost a third of it, more than a third. Okay, so the reason I'm telling you this is to alert you to the strong dollar presents its own problems. The weak pound presents its own problems. The Bank of Japan, the weak yen, and the strong Swiss franc all have their own problems. And so today we had some talk of the S&B wanting to kind of intervene. So if we go look at it from a 4-hour perspective, just get rid of some of these things. Come on, I don't need this stuff here. Come on, boom. Just trying to kind of clean it up. What's going on here? Where's my data? This is a very weird thing. Am I missing something here? Let's go have a look on the browser one. Not really sure what's going on there. Okay, and let's bring in dollar Swissy. Come on. I am just clearly not on fire today. There we go. Okay, finally, thank you. So we had a bit of talk of intervention today, quite a big move that we haven't had in a while. I want to see this as well. Bring it in, and we could see that we had a bit of a push on it. Okay, so that's I mean, that's significant because they're starting to push back a little bit on this, which might ultimately impact the dollar. But also what's going to happen is if all the other banks start to raise interest rates, we could see a bit of an end potentially. We could see the pound starting to strengthen. It's not a guarantee, but it often happens. And so the trends that we've been seeing over the last year could be coming to an end. So okay, so that being said, all of that was for me to sort of get to a roundabout way which says that I think as of today, if we start to see changes in the yen pairs starting to head lower, and we start to see the Swiss pairs starting to head higher, then that at least would give you some explanation for that, and that could change how what happens with the dollar. Let's go back to this. I want to know. I don't really know what's going on here. I want to kind of start it up again. Very weird to me. Some weird stuff going on here. Okay. So let's go across and have a look at, so we know the dollar's strong. We know that it's also overextended. Let's start by having a look at the Dow. So we're going to go up to the Dow here. We'll go up to the weekly. We want to get a sense of that. So first of all, let's have a look at what's going on here. I want to just sort of draw in a couple of things here. We had, in the past, you can see prices kind of generally dipped below the 10 and 20 area here, maybe even in the past has come back to where the 50 period moving average is. Just here went past it and then kind of goes back, and that's where we're coming in now. And we're also coming into a major level of previous resistance that's also potentially support. So until we break this area, we cannot jump the gun. So in other words, we need to have the market prove to us what it's going to do next. So we shouldn't jump the gun, but I do want to say that we have a very clear level of support that we had over here, which you can see the price action came back, produced a bearish rejection of that, and then has followed through on that. So my immediate, so the first thing I'm expecting in the near future is that price will come back to test this level again and connect to the 50-period moving average. Those are that's the immediate target that I would expect of the market to do now. And really, we're only back down at where we were before the pandemic and also just shortly after the pandemic. So although it seems dire, it's not terrible just yet. We're gonna have to see how things unfold. There's a strong likelihood of a recession occurring. Now, a recession has got very negative concepts. Principally, it means as long as we can keep our jobs, our costs are just very high. But here's the one good thing about a recession. A recession is one of the fastest ways to reduce inflation. It's a horrible way to say it, but it's the fastest way to reduce inflation. Okay, so basically people will just not have spending power and then prices will drop, it'll bring it back down and the markets will calm down. So one way to think of it is that would be a solution. That would fix our problems, maybe rather than waiting 6 months for everything else to kind of do. What makes this a very interesting period is that most people, employment-wise, are doing relatively well. Like we coped, we're kind of, they're almost doing better than during the COVID. Some people are almost better off, and so maybe that's another reason why people started spending money, which is triggered, which is added to the inflation. And actually what happens is, even when we knew inflation was a problem, this is a generalization, by the way, I'm not speaking for you guys, but I've noticed that some people didn't immediately start cutting their spending. Basically, they won't cut their spending until, in areas like where you can't. So if you need gas for your car, you can't get around that. But, people could choose to buy a cheaper butter or different milk or something like that to kind of cut costs. And people haven't really done that because it hasn't really, some people are kind of still okay, but definitely, even in our house, we have noticed like difference in the electricity bill because I've got a lot of stuff, computers, and we've got a lot of those things. And the electricity bill is noticeable now, where it was negligible before, it's noticeable. You're like, wow, that could buy a holiday, for us or a flight somewhere. So my point of this is that we're not necessarily out of it just yet. We would have to see, and there are concerns that if your car, for example, your car's going to get serviced, if your car or your teeth, if you go to the dentist, if they are serviced on a regular basis, then you'll probably not have problems. But if you decide not to get your car serviced, and then something runs a bit low, maybe it runs low on oil or something, and it starts to damage the engine, and then you have to get the engine repaired, and then certain things, even though it wasn't a problem in the beginning, it becomes a problem. It could be the same with our economies, where the delay in things correcting or self-correcting means that it triggers other things. So this is really what the fear is that if we leave it too long, then companies who've just posted all record profits here will then start to cut people off, which is really weird, getting rid of people when 3 months earlier you're posting record profits. Which then triggers a whole lot of other stuff. So let's not obsess about that yet. The sky isn't necessarily falling. We just have to be prepared for it, but we'll see how it goes. From an investment perspective, and again, I'm going to quote you, this is Warren Buffett and Peter Lynch. He did One Up on Wall Street, very good book as well. Everybody should read those. For them, the rule of thumb was you never sell. If you have stocks, you never sell. When there's a market crash, you never sell. You hold or you buy. So these are the worst times to sell. You really want to, sell if you have to, when it's on the way up. So these are either you keep your stocks until the market recovers, or you buy if you're in a position to do that. So these are seen as nice corrections of the market where you can get stuff at a bit of a discount. So let's talk about the current price action. So we've got a nice little bearish red candle here. We have got a definite level of support here that could hold. I'm not saying it will, I'm saying it could hold. And one of the ways in which I would know that is if we produce a green candle that looks very much like this here. Possibly not for this month because we're in the last on the last lap of this month, but possibly for October. It's possible. September, historically, by the way, has always been a bad month for stocks. Like something like 90% of the last 100 years, September's always been a poor month. But October, we could have a Santa Claus rally. We could recover from that. So the first sign would be a bullish candle on that, and I want to see how price reacts at this level. However, should price break through that level, then we could start to look at the next levels down, like here and here. And again, the market will recover relatively quickly. I'm not too stressed about that. It's a good area for it to have let off some heat, and we do need inflation stuff to calm down. The cost of certain things is too high. We need that stuff to come down. You know, like rental properties need to get, like properties, rental properties, and certain things have to come down. But the cost of living in some ways is ridiculous compared to obviously our parents' generation. Anyway, so keep an eye on these. We've got, could be a possibility we come down, we hit this level here, and we find some support there. All of that is acceptable. So what I don't want to do, which I think is very dangerous, is to start expecting the market to come down, expecting it to come down to that level. I'm not saying it won't, but it's dangerous to assume the market is going to crash like this, especially when we can sort of see it coming. It's when the market gets a shock that you tend to get a really big move. But when you can sort of see things coming, then the market, we could be in it for a while, but it could just drip down. You know, it could drip down and then start to drip and then start to work its way back up from there. So I just don't want to overreact, and that we've had the most growth we've had in history in the last sort of 10 years, and a correction is almost always proportionate to that. So let's have a look at this from a Fibonacci perspective as well. So let's measure from this low up to this high. And look at that, we haven't even connected, well, if you count this, we connected with a 382. So we've done almost a minimal retracement correction on this. Yeah, so here's an interesting point. So you know, that you were saying here, one of the comments is, well, possibility of the market going lower if Putin uses a nuclear bomb. So here's the thing, right? This is a very much my personal opinion. Please, this is not the opinion of IC Markets or of Trade with Precision. It's just my personal take. Everyone was, Putin gave off the impression that his army was going to just going to wipe out Ukraine, and we can see they're not going to win now, based on their existing tactics. We can also see that he tried to sort of mobilize 300,000 people, and you can see they're heading to the airports. A lot of people do not want to get involved in this war. So based off all of that and the last kind of few months, I anticipate that there's no successful outcome for him here. Like, there's only a couple of things that can happen. Either he won't quit, he can't, because he's losing power. So either somebody else takes power from him, so in other words, there's a coup, or possibly, this is all fantasy stuff, but like Ukraine sends in a special forces group who captures him and then hands him over to the United Nations or something as a criminal, whatever. So let's talk about the nuke stuff. His army and his gear is in, this is relevant, it's relevant to the market. You're absolutely right, we could see something happen. But his gear was also worse off. Like, everything is falling apart. When they were capturing tanks, the tanks hardly worked. And so it occurred to me that possibly out of all the thousands of nuclear bombs he says he has, a lot of them don't work. They're not in peak shape, because he thought people were scared of him. Now he's realizing people aren't. So he's cornered. So could he do something silly? Well, I think honestly, he's probably I don't think he would shoot himself in the foot. I think he would rather use something not as big as a nuclear bomb, but something quite big where he remember why he wanted Ukraine. He wanted it because of its wealth. Russia's going broke. Ukraine provides 40% of the world's, it's got natural resources, plus it's got skills, plus it's got like 40% of the world's sunflower oil. It's got all these different things. Wheat, it's a major contributor to wheat. He needed that wealth, and it's doing really, really well. So he wants the wealth. That's why he wants Ukraine. He's doing it under the pretext of it being, I don't know, he's reabsorbing it. No, it's purely about the wealth. And so here's the thing: if he hits a nuke it now, then it's definitely a done deal. So I guess what I'm saying is, I'm not saying the nukes don't exist. I'm not saying he isn't a madman or potentially a madman that might do something crazy like that. But I think it's possible that I think it's unlikely he's going to. I think it's unlikely. I think it's unlikely. But you know what? We're living in weird times, so we have to be prepared for the worst and hope for the best. But I would like to think that that the people that have to pull the triggers would not even want to do that. Anyway, so all of that saying, yeah, it would be insane to see what what happens with that. Wow, that would be unprecedented. And actually, you know what the fact of the matter is? I think if he was going to do that, then I think there would be a global response, and he would be in so much trouble. So I don't know. Okay, but also he's surrounded himself by yes people, so he's not getting factual information. So anyway. Okay, so I want to move on. I just wanted to say here that, look, this is where we are. There's the 50 fib and there's the 618, and they generally tend to line up with levels. But all of this is still acceptable. You can come all the way back down to 618 and recover, and then argue that the trend is still intact. So I just want to kind of put some perspective on it so that we kind of get a sense of that. And I think our immediate target for now is just this next bit of area here. And this is going to carry on to the other US indices as well. So we'll go have a look at that. And so this is what I'm going to be looking for. So what does it mean in terms of trading opportunities? Well, and you are just acting out. Okay. So what does it mean? Well, here we could double bottom. So what could happen here? We could double bottom here. For trading opportunities, it means it's high risk. I want to explain why it's high risk to short the markets, because when big institutions and wealthy people have lots of buy orders sitting down here for different stocks as well, for Apple, for everything. If you were really wealthy and you had a big stock portfolio, the best thing in the world is when you can buy stuff at a discount. Like if you could buy properties cash when you had cash and the property markets were crashing, it'd be great. So I feel like I'm going to sneeze. So if I mute myself, it's because I don't want to sneeze in here. So there's always lots of buy orders here. So the further down the market goes, it'll often have these big reactions off these levels. And it might not be enough to turn the tide. So the market could keep going, but it's very dangerous to short the market because it falls quickly, but it comes up very quickly as well. And so you really need to be very aggressive. Historically, the market tends to go up. So you really, like, more people make money just buying and holding in the stock market than trying to short the market when it very rarely happens. Like it's anywhere from every 10 years to every 15 years. And it could last 2 years, it could last 6 months. So it's a very dangerous activity to do because you've got to capture profits. And as soon as you get close to a key level, you want to kind of be prepared to exit your position. So you have to be very aggressive and understand the reality of the situation, which is the market can bounce off these levels. So shorting from here down to this level gets very tricky. I'd rather have it break through and then retest and then continue down. And often we know if it's a successful breakout, if the candle closes on the other side, then it's usually a good breakout. We want to make sure the next candle doesn't go all the way back up, then it's just a rejection, a failed breakout. We could very well have a double bottom here. So what would I need to see that happening? Well, on my daily as well, I don't know what is going on with this platform. It's very odd. I just don't know. My connection is good, should all be good. Anything else maybe there? Okay. So as it approaches this level, if it is going to slow down, again, you could have, it's really interesting, you could even have a bounce and then a bounce on the daily and then that would appear as a double bottom on the daily, but also double bottom on like the weekly. So interesting, could kind of happen. I would really have to see then, what I would expect to see as we approach this level is to go down to the lower time frames, to go down to say the 4 hour and start to see a bit of that bullish divergence creeping in. So bullish divergence, for those of you who don't know it, is although you're getting fresh lows in price, you start to get your indicators here start to trend up. So they're not really doing it right now. We're not seeing a lot of very bullish price action out there. At the moment, it's still looking more bearish. The other thing that starts to happen is it's quite aggressive coming down, and then it starts to sort of shadow out. It's the lows start to kind of bottom out a bit. So we get that. Right now, so the 4 hours are a good one to watch out, and especially as we get in around these areas. For those of you who who haven't seen this stuff before, I'm using an automatic support resistance tool called Fractal Support Resistance. If I go to it's free. I'm just going to go up here and just try and find it, and then I'll put the link in. I wanted to open up the link. Where is it? That was not what I thought would happen. Fractal Support Resistance. I'll just find it for you quickly. I'll just go do this. And then I'll put the link in so you guys can so that you guys can find it. Is it this one? I always just quite like it. And who's the company that does it? Indicatorspot.com. Okay. Here we go. Is that where I got it from? Oh, sorry. Okay, I'll do it later. I don't want to distract you from it. So this is, and then I'll send it to you so you can use. It's automated kind of support resistance level. So it's pretty good. I like it. Does different colors depending on whether it's a monthly level or a weekly level. So for now, that's really the goal. So the goal is shorter term expectation down towards these levels to see then how it reacts. Do we get a double bottom, or does it just carry on and just keep breaking through those levels? Okay, could it happen? Yes, it can. So what we're doing as traders is we're not, first of all, let's be clear, we're not trying to predict the long-term future. We're watching the market on a weekly basis. So this week, what do we expect the market to do? We expect it to go down to these levels. And then next week, what do we expect it to do? Based on how it finishes of this week, we update our view. So the best way for you to trade realistically is to imagine that every weekend you're going to update your view. Like, okay, what did it do the last week? Okay, does that mean it's still bearish, or does it mean it's maybe shifting to bullish now? And then look to see if we get those reactions. So let's go and have a look at, say, the S&P 500. And let's have a look at that. So we've got the same thing again. We've got the market coming down towards these lows, and potentially back down towards these levels here. So that to me makes the most sense. If we get another rejection of those lows, we could see then maybe this level will ultimately hold. So then, and some of you've heard me say this, I'm going to repeat myself, I apologize, but we'll go through like that 5-point checklist as to what we would need to see. For some of you who don't know this, we'd need to see this to go into a bull market. Okay, so the rules are, first one is we would need to be on the weekly time frame. So the first thing we need to do is to be on the weekly time frame, which takes a while. So that means that if we're going to go into a bull market, it's going to take us maybe 4 to 6 weeks to do that, to recover, to do that kind of thing. The next thing that we need to see, so the first thing we're going to need to see is we should be on the weekly chart. You'll notice that in the past, here's my 50-period moving average. When we're in a bull market, we're generally above the 50-period moving average. Okay, we're above it. So we need to get back up above that. That's rule number 2. So rule number 1 is weekly time frame. Rule number 2 is we want to get it back up above the 50-period moving average. And here you see we tapped it from underneath and we've carried on down. So a simple way of thinking about it, to oversimplify it, is that we're clearly not back in a bull market until we get back up above that 50-period moving average. So as long as we're below it, we're still arguably maybe in either in a changing market or we're in a bear market, but we're not in a bull market. The next thing I need to see is we need to break the previous highs. So here we actually broke this previous high. So when you have a downtrend, when you break above a previous high, that usually means that this is finished. That phase of the market, downtrend, uptrend, sideways, whatever is changed. That's the first thing we need to do. But then we also need a higher low. So we need the market to come down and produce a higher low. So you've got a low here and another low here. So that's the fourth thing you need. So weekly chart is 1, above the 50-period moving average is 2, break a previous high, which is 3, a higher low, which is 4. And then actually the really most magical thing we can do is break above this high. So in other words, we actually do this and break again above that. So if we could come up here, we would then complete, that would be the 5th thing as well. And that usually would result in us getting above the 50-period moving average at exactly the same time. Almost always when we complete those things, we've done all those different things, we're we're above it and we're safe. And I would want to see that on all the US markets, ideally, and hopefully on some of the others as well, if we could do that. So that will give you a starting point to know, where we are in that. So for now, we should be either looking to sell or we should be not engaging at all. Okay, but also just cautious as we approach these major levels. When they move through those levels, then we can do some clues. Also, you can see when we looked at it from a monthly perspective, that was quite a bearish reaction to that level. So we had a very nice support resistance level that was right there. Boom. Look at how, like, that crisp line. And that was a very strong rejection, a failed rejection. And all we've done is followed through on that. So we expect the market to come at least my next week or month was back to this level. Then I'll reassess what's going to happen. When we go, excuse me, look at it from a weekly perspective, that last week really just did some amazing stuff, is this bearish engulfing candle. We had Tuesday, Tuesday, we had the CPI numbers come out of the US and we had this massive bearish engulfing candle. So on top of the previous monthly candle, the weekly also produced that, which is not a sign of strength. And then we followed through on that one. So you can see the wicks over here. These wicks normally show, it's pushing back. We need to see what happens here as well in the same area. We need to see if we do get that. We could get a green candle next week, but for now, I'm expecting the market to let's go look at the other market. So remember that at the end of World War II, 1945, the US possessed 95% of the world's wealth. So the US dollar is the most widely traded currency in the world. So the US economy impacts the rest of the world's economy. Okay, so just need to be aware of that. Some countries might be shielded to some degree against it. US gets the most growth, might have the biggest correction. We'll have to see. So that's the S&P 500, the NASDAQ as well is in the same, it's in the same boat. They're all the same. They're close enough that the analysis for one of them will pretty much apply to all three of those. So I don't have to repeat that. I didn't put the link in. I'm going to find it for you now. Okay, so I'm going to go find this for you now. Let's see what comes up. Oh, okay. It was this one, I think. Huh. Yeah, I still like it. It's still one of my favorites. I'm just looking to check it is the MT4 version. MT5, doesn't matter. It's the MT5 version. So if you're doing that, here it is, and I will send it to you. The link is here to everybody. Okay. So, and the question is, how long would the market take to recover? So I would say from the point at which we hit the bottom to when we get back over that 50-period moving average, really could be, we could see here, we had a relatively, from this low up to that high, we almost made it over. It was 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks, 10 weeks, call it 10 weeks. So yeah, it could be a two-month kind of start to see a move up and then start to do it. Also, the only question I have now is we broke this previous high here. That was one of the criteria that we meet. Do we now have to break this one in order to qualify it? Possibly. We'll see. Again, a higher low here, to break of that would be fine. Okay. So let's then have a look at, it's a very good idea to have a look at the bigger picture. You need to know where the levels are. You need to know what the bigger picture here is. The monthly, especially with these, because I've just shown you it's a 382, it's done a minor, it's basically done the bare minimum correction on it. It gives you a sense of perspective. It goes, okay, well, we had a lot of growth and we're pulling back. We need to do that in order to do the next leg up. And so it's always a good idea to, let's look at the DAX. So go to the DAX, let's look at Germany, and let's zoom out and get some perspective here as well. So where are our major levels? Well, I do count one of those as a bit of a level. And then I also think there's a little bit of a kind of a little something here. Okay, but we're still doing okay. The correction in some of these parts hasn't been so bad. Nice green candle there, we just sort of gave it back. So the test is going to be over this week and next is how strong this level is. Does it hold? Otherwise, we're going to come back down to these lows here. And I mean, again, if we did, we were here in 2020, August 2020. It's not, only takes 6-7 months we'll be back up. And again, when the market's going back up, we've got all that time to look for trading opportunities to the upside. So yeah, so that just means, and this is just very dangerous to trade. It's not, you see how this is the danger. Moves down, corrects, drops down, corrects, moves down, corrects. That's right. If you're going to sell, you need to take profits, and don't think that you can ride it all the way down. You take a profit, cover your stop loss, take a profit, cover your stop loss, do all those things. Because you can see the market, as soon as it goes down, it becomes attractive to buyers and they buy. So the DAX is not looking terrible, but it's also, oh, and one more thing I would highlight here in the price action. We've got a series of lower highs, lower high, lower high, lower high, lower high. So meaning it's doing this. That's a terrible way of doing it. There, then there, then there, then there. That's usually a bearish pattern, usually. So we could see a break out of here down to here at least. So we'll have to see how that ultimately unfolds. And you can see that strong level of resistance is. Cool. And let's look at the FTSE. Again, looking at that monthly, we've been in this area before. So for the UK, we've been in this area since 2016. We don't have the same kind of growth. The only concern I have is not so much the growth, but do we, not that we have the same kind of growth, but that we're not as weak fundamentally, that we're not, that we don't fall back below this level. I would really hope the 7,000 level holds, because we were stuck underneath it for 30 years, and then we actually connected with it 3 times over 30 years, finally managed to break through. So I want us to get past that. We clearly don't get the same kind of growth, but if we're stable, I'm okay with that. So this level again is going to be very important for the markets to test. And you know what, it's worthwhile, and I don't know the answer to this, but I will look it up for next time. It's worthwhile looking up what happens to stock markets when wars break out. So I'm asking that because, to go back to the original comments about Putin using any massive, like nuclear arms or something, that might give us an indication as to what the markets might do. Would they suddenly climb, or what would happen? You would think they would tank as well. And we should check and see if that does the case. Let's look at the ASX. So this is Australia, just to give us broad perspective there. You can see that's coming back down towards these lows here. So the 50 is an area where we have turned around in the past. We've almost always managed to turn around that area. So the seriousness of the current situation, to me, is going to be, we'll know soon. If we can't turn around here and we manage to go down, then we're definitely in sort of, not uncharted territory, but we're in a serious situation. But I believe it pays to be optimistic. We could be range bound for a while, or we could recover. We'll see. We need to see what happens when we get down to these levels. Let's go and have a look at some of these other indices as well. Okay. So we've got, I normally follow the DAX. It's the biggest one. It's 10 times as big as the UK one. It's free. So I usually follow that. So I don't really subscribe to the EU one or the French CAC. We're going to have a look at the Nikkei as well, and then we'll have a look at some of these others here. We want the Hang Seng, which is the Hong Kong. We can have a look at the Russell 2000 as well, which is I'll explain why it's a clever idea. And let's look at China, just out of interest. That's it. That's all we need for now. That's plenty. So for now, yes, the markets are heading lower. They're coming down to these key levels. So I could cautiously short down, but I would be very careful with these levels. Just trust me on this, or have a bit of faith that these markets can bounce off these levels quite quickly, and they can climb very quickly. So you end up selling, and then you're like, oh, I'm nicely in profit, and in seconds it's eroded, it's gone all the way back up. And I just want to explain why that is the case. So we've got the Nikkei. Let's look at the Russell 2000. So why do I do this? Well, in the US, you've got the Dow, which is one of the first indexes, which was the Dow Industrial Average, which was 1896, I think, Charles Dow. I think it was Charles Dow, not to be confused with Charles Darwin. And the idea with that was it was fantastic because it was tracking shipping and rail, and it was in the industrial era. So if those companies were doing well, I mean, the economy was doing well. So it was a really good indicator of that. Then they produced the S&P 500, which was sort of large cap companies, and 500 of them. And these usually include brands we all know. They're global. So you've got your McDonald's and your Starbucks and Nike and Microsoft. They're all over the world. So it's a really good thermometer of companies whose products are being used globally to get a sense of how they're doing. And then you've got, out of all of those, you've got the tech stocks, the NASDAQ 100, which is 100 top stocks as well. And that's got your Facebook and your FANGs, which is Facebook, Amazon, Netflix, Google, Apple. And there's another one, I think. Is it Microsoft? Anyway, they've added to it now. And then you've got the Russell 2000. So the Russell 2000 is small cap companies, meaning the next 2,000 companies out of the US as well. So when you think about it, when you look at the Dow, the S&P, and the Russell 2000, you get a very good sense of the US economy, and therefore the global economy, because in those 2,500 companies, if you merge these two, you're getting companies that are all around the world in every country. So it's a good idea. It gives you a good sense of what's going to impact them. Okay, then, so we can see nothing has changed. All of them have produced the same monthly candle. They're all heading down towards the lows. They're all typically heading down towards a major level, and that's what we have to keep an eye on. Then we go have a look at a few different countries. So let's look at Hang Seng. Let's start with that one. Now, this index has been, and I'm going to just get rid of all the objects. All of them. It's just there we go, nice and clean. And this is very bearish, pushing past these lows. And it's definitely, do we have more of that? No, we don't have more of that history, but definitely pushing past these lows and way more bearish than almost all the other indices that we looked at. So we looked at all the way from the US through the UK, through Europe, to even to the ASX out of Australia. And all of them had generally had a nice bullish move to the upside, except when we come across here to Hong Kong 50, that it's very bearish. And in fact, it's been hitting low since 2017. It's generally hitting low. Could it be as a result of political instability? I don't know. I'm afraid I'm not qualified, I don't think, at this time to speak on it. But it's very bearish. So here's a thought. One of the things we could do is, if we want to short the market, for example, if we're looking at stocks, is I want to short the weakest stocks, because if I short the weakest indices, if I sell the weakest indices and the weakest ones, they are the ones that are more likely to head lower. What I think might be foolish or dangerous or higher risk is to try to sell a strong stock. So something like Microsoft or Google, or something that does really well, or Apple. Try and short that. That's like you're trying to take on the biggest ones, the strongest ones, the ones that are more likely to survive. And so I would rather short weaker stocks if that was going to be the case. And then in a bull market, what you want to do obviously is buy or look for longs on the strongest stocks. So you're accumulating things that will go in your favor, if that makes sense. So yeah, so here the major thing is, will this level hold? It is looking like it might not. We're going to have to see how the month closes. If we close down below here, it's looking very, very bearish. If it manages to recover and rejects that, we could be good. We've got about 8 or 9 days before that happens. And let's have a look at Japan, the Nikkei. Just wait for it to kind of do its thing. And while we do that, we'll just load up China into a new chart window as well, so that we've got that data. So yeah, the Nikkei doesn't look that bad. Again, it's also coming back down towards these old lows. Look at the buys trying to stay in there. The beauty of why I love price action is because price action is the actual orders going through. Instead of a newspaper article saying George Soros is doing this, or Buffett is buying this, or he's selling this, which could sometimes be propaganda that gets put up by Goldman Sachs or something. They do pump and dumps. They can be, they can do that kind of thing. But generally speaking, this is an indication of what the market is trying to signal to us, what its intentions are. So it's saying, I am quite strong. There's a lot of buyers here that keep pushing up, pushing up, pushing up. Does it mean that the markets will succeed? In other words, when you see this, you think the market's going to hold and it might push up. Doesn't mean it would necessarily succeed, because we have, the problem is we have a lot of buyers underneath here which are propping it up, but we don't have enough buyers above here to take it on. And you need both. So what can happen then is, eventually in this area, somebody's going to cave. And so if the market keeps coming down, these wicks will go away. So suddenly the candles will start to close near the lows, a lot more near the lows, and then it could start, and then it could fall through here. And the people who are buying there, their stops get hit, and then it goes further. So most people have the best of intentions when we do this. And there's another level down here potentially. We'll see how that holds. These are the major levels. I keep watching those and see how the market reacts to that. But clues are, if price keeps coming back to a level and then it starts closing near, the candles are closing red right near the bottom with very little wick, that usually means that it's probably going to fall through. Okay, it's probably going to fall through. Whereas if you keep getting wicks, then you've got some pushback. So the wicks, they give you some really good, they're very powerful. They give just lots of little things like these. I love little twin wicks, because I honestly, in the last year, up until the last year, did not appreciate how this is effectively a double bottom. If you go down, it's price doing that. So yes, we've got lower highs and we've got a low low. So we are still in a downtrend until we break this high. Until we break this high, we're still in a downtrend. Meaning that we could bob around here, but until we kind of break, we're still in a downtrend. That's our structural high. And you must also understand that when the market does stuff like that, when it breaks that, then all of a sudden people get in. Even you and me, all of us list in the webinar tonight. There's a point, if you were looking to buy on a trade or buy stocks, if you were doing that, you're always going to be interested when the market is especially going to new highs. So you might not even know this, but in your future, you might want to get in when the market is back up here. So just understand that when the market, it's like a snowball effect. When the market goes above a certain level, people get interested. They might already have their orders in place, but they also get interested in it. And again, if it drops to a certain point, people will sell that really didn't want to sell. So that's why we have unrealized sellers and buyers down here, and we have unrealized buyers and sellers up here. That are people that haven't even placed their orders yet, but they're going to get interested when the market goes. So it's a snowball effect when it breaks above those previous lows. So far, the Hong Kong one is really looking very weak. Let's look at China as well. So China and Hong Kong, and again, they're related, right? Hong Kong is largely Chinese. So they're related. Their markets are possibly taking a lot of pressure. Now, it actually makes sense. I don't know if you're aware of this. It's very interesting. It's not been covered a lot. It's been covered on YouTube. It's not been covered in our newspapers too much. But China's got a big real estate problem. You know, they've got their own issues. Their economy has been growing so fast that they've been building properties, entire cities where people, and most of the individuals, the citizens, have been investing in properties. So imagine that a lot of that wealth is tied up in empty cities that are now just kind of, so there's a bit of a property bubble there that could be a problem. So where everyone was afraid that somehow China would be overtaking the US and their economy is on fire, they've also hit their own problems. So it just shows you that, you know, everybody has stuff. There's no perfect kind of setup. I bring it up because it appears to me as though we've got a similar thing, similar to HK. We've got this general decline probably from 2022, but also going back to 2017. Let's have a look at our weekly. There, look at that. Seems to have peaked. Okay, so Hong Kong was 2017, this is 2020, and it appears to, might be due to COVID. Maybe, you know, the economy's taken a bit of a hit. So again, we can see this is a big problem. Now, could China's economy going through a rough patch, I don't want to use the words collapse. I think that's alarming, and I don't want to be alarmist. Could something like that impact the rest of us? It could, it's possible. I mean, they say that there would be an impact, but I'm not sure yet how that would be compared to the US. But yes, China's integrated into most economies. So yeah, there would be an impact if something happened like that. But also they would pull out all the stops to do whatever they can to obviously make sure that doesn't happen. So my sort of immediate, let's call it medium term. So shorter term is the next few days, next few weeks. Medium term is maybe the next 2-3 months, and longer term is maybe the next 6 months. My sort of medium term, shorter term and medium term is really just to see how the markets react here. It would be very interesting to see if this can, China starts to recover, starts to break up above that. But I'd be surprised if it's been struggling for longer than the US. It hints, by the way, that the Chinese economy is not catching up to the US economy anytime soon. The US economy is still pretty strong. It's very robust. It's very robust. I don't know if I've said it before, and I know people have different opinions on Joe Biden and on Trump and everything. But here's one of the things that I admire so far, at least about what Biden's doing here. He's worked out what's been happening over the last 10 years in the US is that the wealthy have gotten wealthier. So there used to be a middle class, and you used to have a very small band of millionaires, which then became billionaires. And so you had largely the middle class was the biggest one, and then you had a small sort of lower income bracket. And so what's happened in the last 10 years is tax breaks have been going to the uber wealthy, into the corporations, and the middle class has almost evaporated. They've either managed to stay above a certain bracket, or they've gone into the lower income, poor income class. And so Biden's decided to rebuild the middle class. So the goal is tax the billionaires, tax them a reasonable amount to help recover, pay off the debt, rebuild infrastructure, do all these different things. Try to get the middle class strong, because remember that the billionaires got wealthy off the middle class. That's where they got their money from. So those are the people buying all, you know, iPhones and everything else, expensive cars and stuff like that. So the basic idea is he's trying to rebuild the middle class by taxing the upper bracket. So what it should do is calm down, narrow the gap. The middle class obviously spend a lot more money on the lower income brackets as well. So that's the backbone of the country. And I think if he pulls that off, America is going to stabilize, which is going to be amazing. And it might even set a template for other countries to do the same thing. Anyway, look, I'm not super wise about this, but that was the concept and it makes sense to me. So just highlighting, just recapping on here. So the Nikkei is not looking that bad. They look relatively stable. They've stayed here for, if you kind of go back, price is generally in the same place that it has been in since 2020. Not hugely, it just isn't growing, but it isn't really tanking either. But when we look at the Hong Kong and China, we see a bigger move to the downside. So in terms of day trading opportunities, I might rather look to short like the China and Hong Kong ones for smaller day trades, because they're definitely weaker, rather than try to take on the Titanic, which is maybe the US and the other economies. So we've got a bigger picture. What we're trying to do, if we just kind of go and recap on this, if we've got that bigger picture, this is an area where we expect there could be a bit of a bounce. We would need to see a full bullish candle in October. We'd need to see that, but we also can expect that the market is going to wobble around these areas. Should something unexpected happen, we fall through this, then we might, then we might start heading down to these levels. But at some point we'll bottom out. At some point the problems will be recovered, or they won't be so bad. And the sentiment is a big thing. So I want to wrap up by saying that when the market gets down here, that's usually where everybody is like, it's never going to recover. It's never going to recover. Sentiment's at its worst, and then the market recovers. So please don't think that the market starts becoming optimistic and then it recovers. It's usually up 2 or 3 months later, and then the market goes, okay, well, maybe we're not in so much trouble anymore. So just remember, the sentiment is not a great guide. The sentiment, there's a massive lag between at least 3 or 4 months between the public sentiment or the general sentiment and the candles. Okay. I'm trying to focus here. There we go. That's what I'm looking for. So, ladies and gents, I'm just keeping an eye on the time. I want to make sure I've answered all your questions. You had CAD and Swissy, yeah. So we had obviously Japanese yen and GBP. We also tried to up their rates. They've also done that. So we, in a way, those kinds of things should create nice moves in the market. But if we get these big moves, they could be a correction, and then the trend just keeps going. So in other words, the Swissy pairs could keep going down, but this is the first attempt of the central banks to start to change those trends. And that might work, we'll see. If we get really strong rejection candles on the monthly, so if we go to, say, dollar yen, so let's just go back to this, and we go look at, say, something like dollar yen. I'll just quickly do this, and then I'll show you this. So we look at the weekly candle. You can see it's struggling here. You can see that. If this closes near the lows, then we might actually find that it's, and we've got some bearish divergence here as well, we might find that it's going to come back down towards here. But if it doesn't, and it starts to close up near the highs, then that trend, then it's too strong. They're going to have to do more. They're going to have to, sometimes they have to intervene several times to really get the sentiment and the people to change. Because it's hard to get everyone to change stuff they've been investing in. If you're talking about investment firms and hedge funds and whatnot, if they've been adding to their yen positions over the last 6 months, it's going to get hard for them to change their minds in one day. They might take a few weeks or a few months to move on. Yes, you guys too. Listen, have a fantastic weekend. Thank you very much. There's some absolute yield is high, which indicates not good for the economy. Yes. So those kinds of things, inverted yields, all these different things I'm talking about, but the chart should reflect it. So yes, guys, please have a fantastic weekend. I really enjoy my IC markets. I only do like 4 webinars a week. I don't have a lot going on. I mean, I trade, and but I don't have a lot of, like I said, of webinars. So it's nice and fun to talk to people. I want to wish you a pleasant evening. Please go and spend some time with your loved ones, have some good food, or some good TV, or relax for a bit, enjoy the rest of your evening, and let's see what happens. Don't forget, there's lots of news coming out tomorrow as well. So we live in unusual times. The markets are extremely sensitive to anything to talk about inflation and how they react to that. And that isn't always the case. Maybe when this is over 6 months from now, we won't be talking about inflation at all. We'll move on to other stuff. But right now, anything that could talk about the cost of living, anything increasing, any economic calendar news that comes out could make the markets more volatile. But that won't always be the case. Okay, this is the second time in my career that I've seen the markets do this. So it's not always around. It's very rare. Okay, so listen, thank you very much. If you have any questions, please don't hesitate to get in touch with the lovely folks at IC Markets. You've got the email address here and the phone numbers. You can screen grab this and follow them on social media. And I just want to say thank you for giving me your time. And I look forward to seeing you in future webinars. To my regulars, thank you. You being here and being part of this is always appreciated by me. Okay, thank you very much.